I'm attorney Ramsey Bahrawy, and this is Your Money, Your Life. In this segment, we will discuss whether a new year will bring new possibilities to the global economy. For example, will 2015 bring new risks as well as opportunities? What events may influence stronger growth, better economic performance, and a rise in interest rates? Joining me in this discussion is Michael Pansovoy, the president and founder of North Andover Trust Corporation, a company offering comprehensive wealth management services. By way of background, Mike spent a combined 13 years with Kidder Peabody, Payne Webber, and UBS. Thereafter, he established North Andover Trust Corporation, which he has successfully managed over the last 12 years. Mike, welcome to Your Money, Your Life. It's great to have you on the program.
Thank you, Ramsey. Nice to be here.
Now, Mike, the markets react to news. They react to information. Whether that information is international or domestic, or whether it's some sort of news from the Federal Reserve Board, or whether it's political information from Washington, D.C., or whether it's some sort of international event, such as terrorism, or whether it's some sort of domestic event, the markets react. Isn't that right?
Yes, it is right.
Okay. So what I'd like to do is I'd like to go through a series of possible events in the year 2015, and let's talk about how the markets may or may not react. Let's start with the United States dollar. The dollar's been strong. Will the dollar continue to strengthen in 2015? And if it does, what are the implications for our economy?
Well, there is a good possibility that the dollar will continue to rise. However, I think the Fed, as you mentioned before, may take notice, and it's probably not in their interest to facilitate the rise of the dollar.
Why do you say that? Why is it not in their interest?
Well, the Fed wants the economy to grow, and because a stronger dollar can crimp the margins of multinational corporations, that will slow the economy in turn, and the Fed doesn't want that.
Okay, so you raised a good point with regard to multinational corporations. Could you explain to our viewers how a strong or a weak dollar affects multinational corporations, which are corporations that do business globally?
That's right. With a stronger dollar, we have the buying power, but our customers don't overseas. Mm-hmm. In reverse, when the dollar declines, our customers have greater buying power, so they can afford more of the products that our companies produce. And therefore, that creates a better growth opportunity for the economy where these companies are involved.
So that really means that a multinational benefits from a weak dollar in foreign economies.
That's right.
Okay. All right. So since we're looking at a strong dollar, then that's actually a negative for multinationals, because you just said you're expecting the dollar to continue to strengthen. Are there areas of the economy where the strong dollar is a good thing?
The strong dollar, in turn, brought us lower oil prices. Mm-hmm. And the energy companies perhaps don't benefit from it, but the energy is only one of the 10 sectors in the S&P 500. Mm-hmm. So there are 9 other sectors that probably will benefit from it, as in transports, airlines, the consumer. Mm-hmm. And with every dollar decline in the price of gasoline per gallon, the consumer benefits tremendously, and that increases a buying power of our consumer, as people say, the good old consumer, and with more dollars in the pocket instead of in the gas tank, they can go out and spend the money elsewhere.
I see. So it gives them the freedom to be able to spend the additional money, or to spend certain monies that they would have spent on energy costs somewhere else. And that's good for the economy.
Yes. In the long run, that will make it better for the economy because the consumer can make it. We are a 70% consumer-based economy.
Now, what does the strong dollar do in terms of our federal government debt and the deficit? Does the strong dollar in any way affect the government debt and the deficit?
Well, the interesting thing is that the strong dollar attracts foreign buyers to the U.S. Treasury. And
why is that? Why would foreign buyers be attracted to treasuries when we have a strong dollar? Wouldn't that make the treasuries more expensive for them?
In a way, it may, but it gives them a higher rate of return. For example, if you look at the international interest rates on a 10-year treasury, whether in the United States or other countries, and in this case, I just looked at the rates today And a 10-year Treasury in the United States is yielding 1.83%, but in Germany, only 0.42%. And so, on one hand, U.S. Treasury could be expensive, but it also pays you more. And that makes it more attractive. And credit quality of the U.S. Treasury is higher than any other country in the world.
I'm confused. I mean, if the U.S. Treasury has a higher credit quality, shouldn't the yield on the U.S. Treasury be lower, because shouldn't credit quality be factored into the interest rate return?
Well, it should be. We're also going through an interesting time when the Fed tapered the purchasing of bonds, and the European Central Bank is about to start. And that brings the European rates lower and perhaps keeps the U.S. rates somewhat higher. So it's an artificial distortion, but that's what it is today. And when people realize that you have higher credit and a higher rate at the same time, that makes it attractive to investors worldwide, particularly when a rate, as I just quoted in Germany on the 10-year, is 0.42%, which is less than 0.5%.
Wow. I know you've got a list of various different governments, and the one that stands out to me is Switzerland.
Switzerland is even lower. It's 0.15%.
Wow.
And that is a traditional safe haven for money,
Yes.
but at this rate, it's not so safe because it doesn't pay.
Wow. So after taxes and inflation, you really are losing money.
You're right. You're paying the Swiss government to hold your money.
To hold your money.
Right.
Wow. Doesn't look like a smart investment to me.
Well, that is why the flow is into U.S. Treasuries currently, and that makes it more attractive.
I see. Now, we've been seeing, as you've mentioned earlier, falling energy prices.
Right.
If energy prices should continue to fall, and if, as you mentioned, with a strong dollar, that's likely to be the case, what are the implications for our general United States economy if energy prices continue to fall?
The energy sector is about one out of 10 sectors in the S&P 500, and companies that are involved with energy, they will probably have a tough time for a while because the oil production cost in the United States is very expensive. It's about 10 times as high as it is in Saudi Arabia, for example. And so U.S. producers do need high oil price in order to be profitable. However, other sectors in the economy will benefit. For example, airlines. As the jet fuel reduces in price, they will benefit. Airlines are traditionally operating on thin margins, and that will help a sector like transportation, delivering goods worldwide, whether this is a maritime tanker or an airplane or a car that a consumer drives. So overall, the economy will, in the long run, benefit from oil energy costs than the other way around.
So if transportation costs decrease because fuel costs have decreased, does that mean that those savings get passed on to the consumer who ends up buying those goods, whether it be food or whether it be durable goods?
Usually it does. Delivering goods costs money, and therefore by the time you get it, it costs you more. And that's another implication in the current environment. We do not experience the inflation rate. That is what the Fed says. Our target is about 2%. And right now we're significantly under that. And that is another item that may curtail the dollar from rising too far because the Fed may not act as quickly in raising rates.
I see. Does a stronger dollar have anything to do at all with regards to our inflation rate? Is there any sort of connection there?
There is a connection, and the stronger dollar actually is deflationary, and that is not what the Fed wants.
I see.
They want the inflation to be moderate, and in their minds it's 2% annual rate.
Okay, so we've talked a little bit about a stronger dollar, possibly in the year 2015. Now, can we focus our attention on bonds for a minute?
Yes.
Okay. So as you pointed out, in foreign countries anyway, the yield on bonds or the interest rate on bonds has been very, very low. What about corporate bonds, bonds that are issued by corporations, private companies? Going forward in the year 2015, where potentially are corporate rates going to go, presuming, again, we have a strong dollar and presuming that the current strong economy continues?
If the strong economy continues, the corporate debt will do well. Spreads between the Treasury and corporates do spread or narrow over time.
What do you mean by spreads?
Well, the way the corporate market is priced, it's, let's say, U.S. Treasury on a 10-year is at 183, so people will say it's U.S. Treasury plus 3% for a quality corporate paper.
I see. So using the 183, then a quality corporate paper should be paying 483 or thereabouts.
Right. Okay. And sometimes it's greater, sometimes it's lesser. And depending on the appetite in the marketplace. Usually when the market senses that a recession is on the horizon, the spreads widen because corporates are not guaranteed by the government, they're only guaranteed by a company. A company may go out of business. And therefore, people will want more from a company in return for taking the risk, for lending the money to the corporation. However, at this point in time, the spreads are still fairly reasonable. They're not very wide. And that implies that the recession is not on the horizon, at least at the time. And therefore, investors are willing to tolerate the risk and accept a return that's better than what the governments are paying. And that's basically indicating that the economy is still expanding. It's not contracting.
So just so that our viewers can understand, when you say widespread, how is a widespread defined? What kind of numbers are we looking at?
When corporates pay double-digit returns,
I see.
Then you would say the times are pretty bad. If somebody has to pay that kind of an interest to obtain a loan from a lender, that means that the risk is very high, the default rate is right there. It's measured in high numbers, and therefore people are not willing to lend unless they get reimbursed really well.
Now, I have same question for you, except instead of corporate bonds, I want to talk about junk bonds. So again, if we can presume for a minute a strong dollar, and we can presume that the economy continues to move along and continues to grow as it has been, what does that mean for the junk bond market?
Well, the junk bond market is, again, it's a corporate market, except poorly rated, or maybe unrated. Mm-hmm. And of course, that segment of the market has to pay more to obtain the loan for someone to buy this paper. And the spreads widen more on poorly rated or unrated paper instead of a highly, which is investor grade corporate bond. And that tends to be a little bit more delicate or vulnerable to a downturn in the economy. At this point, there is no indication that the economy is turning downward in the United States. But the corporate bond market is also involved in energy. And so the energy producers also issue corporate debt. Mm-hmm. And so when those companies experience a hard time, people immediately assume perhaps their debt may not be repaid. And that affects the yield on the issuers such as energy companies.
Now, you mentioned a little bit earlier that the Fed is concerned about inflation. Now, if we can presume for a minute that there'll be more inflation in the year 2015, if we can also presume for a minute that the economy doesn't continue to grow, it starts to stagnate, what does that do to bond prices?
If there is stagnation and there is inflation at the same time, and we've gone through that in the early 80s, and that is called stagflation, it is not a good indicator for bond buyers. That means the bond prices will go down and those spreads will widen from the current levels. And if that is the case, we may get into a recession, including other parts of the world, because Europe is sort of on the brink of that. They're trying really hard not to get into it, but there is no guarantee they won't. And if we are pulled into it in tandem with Europe, let's say, yes, bond prices will fall.
You're mentioning Europe, but let's talk about a country that's been in the news recently, Russia.
Yes.
How does Russia affect the United States?
Well, at this point, they are affecting by either producing oil. They are a large oil producing country, and they are continuing to produce oil because they need the petrodollars. And of course, it's also a political connection. There is a lot of political and economic ties between the two countries, and so far, Russia seems to be affected more by this because they get hurt by the decline of oil in price, and they need that. It's their one of the major revenue sources, and that's really, so far, it appears that Russia is affected more than the United States by this situation.
I only ask about Russia because, like I said, Russia's been in the news.
Right.
It's been in the news over several issues,
Yes.
not just the one that we've discussed. Now let's take a look at the stock market. The year 2014, the stock market actually performed quite well.
Right.
Early part of 2015, we've seen what I would refer to as a lot of volatility. There's been a lot of movement up and down in the stock market. Is that volatility, is that a signal of some sort? And if so, what is it a signal of?
People like to ascribe a signal or some meaning to the first month of the year. Interestingly enough, last year, January of 2014 was also volatile. And many analysts said, oh, first month is not a great month, and therefore the year will be that way. And it turned out to be false. I think just because it rained for 3 days in a row does not mean it's going to rain another day or so. People like to attach significance to something that perhaps is not rooted in fundamentals. Fundamentally, the economy is expanding. The last GDP report was better than expected. We have issues, but it appears that the economy continues to expand. In fact, today, Philly Fed report also showed a moderate expansion in the economy. Again, not all perfect, but it's not contracting, and that's good news. So I think even though volatility may persist, no one can really predict what the market will do. I just think it doesn't mean that just because we have a volatile January that therefore the whole year will be that way.
Okay. You mentioned we have some issues. What kind of issues do we have?
Well, inflation or lack thereof is one major issue that the Fed is watching right now. And in fact, today, producer import-export prices, they went down year over year on the export side, 3.2%, on the import side, negative 5.5%.
And what's the implication of that? What does that mean?
Well, that is bringing the inflation down. In fact, people don't like to quite say it so, but they're more afraid of deflation. And if deflationary force takes hold, it's much more difficult to combat than inflation, because the psychology of the consumer is such that if I can wait until tomorrow or later at some other date to purchase something because it's only getting cheaper, there is no incentive for them to spend. And therefore the economy slows down significantly. And that is what the Fed wants to avoid.
Based on some of the reading I've been doing anyway, it appears the stock market has been moving on every tiny little bit of news that's come out. Is that normal that it moves on every tiny bit of, and I don't mean move 10 or 20 points, it moves 100, 200, 300 points on a piece of news, and then moves 200, 300 points in the other direction on a different piece of news. Is that normal?
It seems exaggerated, and it is much more normal now than it used to be. What people refer to now is a new normal. And the reason is we are living and investing in a 0% environment. And so investors don't really have a choice but to chase something. Otherwise they get no returns, sometimes they get negative returns. The US TIPS, the Treasury inflation protected securities, are still negative in up to 5 years in maturities. And that indicates that there is no inflation. The yield is negative. And people don't want to simply lose money in a guaranteed way. And so they're beginning to seek other venues, and the stock market is one of them. And so all that cash that is freed up from savings is chasing something different, including the stock market.
Okay, so if I'm hearing you correctly, you're basically saying that cash that might go elsewhere, whether it would go into bank accounts or certificates of deposit or bonds or other alternative investments, is going into the stock market because that's really where the yields are today.
Right. People are seeking return, and they look at the performance of the last couple of years and say the S&P had done great, therefore I need to go there.
Okay. But aren't people also taking on significant risk when they start
Definitely.
investing like that?
Yes. They take on significant amount of risk, and it's called risk extension. However, people feel they don't have an alternative or a choice. And that is the behavior, and sometimes it's important to say don't follow the crowd, because time and time again, people get hurt in the stock market, and it's better to not earn 2, 3, 4% in a stock as a dividend, because you can lose 10% in a day. And so it's very important to be very careful.
You know, I remember having a conversation with you, and this would have been maybe 15 or 20 years ago, in which you were you were referring to what used to be called the widow stock, AT&T.
Right.
And how that was the safe stock, and widows would put their money in this stock and they would get a dividend and the stock would hold its value. Is there any such thing as a widow stock today?
I would say probably not.
Probably not.
Things are very volatile. Companies change. They get bought out. If they do pay a reasonable dividend, they are chased, and all of a sudden the price of the stock went up so much where if the market has a temper tantrum, you may lose 10% in a day versus trying to get a dividend of 3% a year. So it's not a healthy situation this way.
And of course, you know, the average investor doesn't have access to information so that they can actually make a change in their investment quickly. You know,
right.
By the time they find out what's really going on, it may be actually too late, right?
Usually it is.
Yeah.
It's a lot of noise, not a lot of good information.
Yeah.
Right.
That's interesting how you put that. A lot of noise, but not a lot of good information.
A lot of headlines that don't quite say anything new. Sometimes the news are recycled, and you see the same headline, same conversation on TV, sometimes, or radio, that just repeats what we already heard weeks, months ago. And for everyday individual, it's hard to know what's going on.
Now, you mentioned a little bit earlier about company fundamentals not necessarily being where they should be. If going forward in the year 2015, companies' fundamentals either stay the same or decline, that's not good for stocks, is it?
It is not.
No.
The investors usually want some kind of revenue growth or earnings growth, and if that isn't materializing, then they will assume the next step is down. And they don't want to be there waiting for it.
And if the Fed determines that there is inflation in the economy and they decide to raise rates, is that a negative or a positive for stocks?
I think it could be viewed as a positive, because the Fed will have some kind of confidence that the economy is doing well enough for them to raise rates.
I see.
And the precedent for this is actually occurred right after the previous recession of early 2000s, when the Fed raised rates 18 times, and the interest rates actually did not go up, and the economy did better.
Do you think, and this is I'm asking for a personal opinion here, do you think that the current stock market is potentially in a bubble like it was in 1999, 2000? That was the internet bubble.
I think it's different. In some aspects, it could be sort of bubble-like. I think it's more depending on the sector you're in, and we tend to deflate those bubbles one at a time. Currently, we've deflated an energy sector, and I think that would say to the market, the rest of the market is probably healthier than it appears. Again, the stock market can do all kinds of things, and that's why it's important to understand before you get into it.
So the U.S. stock market has done well, but not so for the international stock market. Why is that? Why haven't other countries done as well as the United States?
Well, the United States appears to be the strongest economy currently in the world. Even China and Europe are not keeping up with the rate of growth in the United States, even though it's tepid. And therefore, the markets that represent those economies do not go up because the economy in those regions are not doing well.
We have a Republican-led Congress now, Senate and House. Does that have any implications for the economy in the year 2015 in the markets?
I think it does if they can be constructive and implement certain strategies that I think would be business positive. Mm-hmm. And if they can do that and work with the White House administration and have things done and passed, I think that could be constructive.
What if we end up with a divided government? What if we end up with a Congress and a president and they're not able to agree?
Unfortunately, we've experienced that for the last 6 years or so.
True.
And it looks like the markets have ignored that for the most part. And looks like markets tend to look ahead, and they understand that the current administration only has about 2 years left, and we are getting elections another set of elections coming up in 2016. So the markets tend to be optimistic and hopeful. So far, they shrugged it off. Okay. And whether this current Congress can work with the president and create something constructive, and I hope they can.
And what you're also saying is it's possible that the markets just shrug it off and say, it's not our problem.
Sometimes they do that, even though we had some concerns, but it looks like most of the concerns were shrugged off and we moved on.
Good place for us to stop, Mike. No one has a crystal ball. Therefore, predicting the future with any kind of accuracy is, to say the least, difficult. Forecasting the economy is made more difficult given the inherent complexity and randomness of markets, human behavior, and real-life events. But what we can do is to better understand events by becoming more educated. Once we're better informed, we have the confidence to make empowered decisions. No doubt each person's financial needs will vary, yet everyone benefits from being educated about current economic conditions. In addition, working with a trusted advisor, such as my guest Mike Pansovoy, to develop an effective and realistic plan and strategy can eliminate stress while advancing your peace of mind. In closing, thanks to my guest, Mike Pansovoy. Mike, thank you very much. Interesting information. And as always, thank you to you, our viewers, for watching Your Money, Your Life. My name is Ramsey Bahrawy, Building Your Trust.